You know, traders often ask me the same thing. Mark, how do you seem to know when a breakout is forming before everyone else sees it? Oh, well, that's exactly what we're diving into today. 3 psychological and structural clues that reveal when the market is preparing for a breakout. If you remember our previous discussion on how belief and perception confirm your trading reality, this lesson will feel like the natural next step. Because once you understand how to confirm what's real on your chart, the next question is, how do you recognize it before it becomes obvious to everyone else? Trading at its core is a mental game of waiting, not for the impulsive, not for the gambler. Most traders lose because they can't wait for clarity. They react before the market gives them feedback. They act out of fear of missing out, not from confidence in their edge. But when you learn to read the market as a reflection of collective psychology, you begin to see subtle shifts, the quiet tension before the move. That's where these clues begin to speak. The first clue is one I've watched play out thousands of times in every market: tight price action. When price that once flowed freely begins to compress, smaller candles, smaller ranges, less noise, that's not weakness. That's psychological pressure building. The crowd's uncertainty is being condensed into potential energy. You can almost sense the tension. Ask yourself, when has the market ever stayed still for long? Never. Every contraction is the market inhaling before an exhale, that narrowing range, that calm before the expansion. That's your first sign that energy is being stored. Here's where most traders fall apart. They see that contraction, and they jump in early, thinking they're ahead of the crowd. I used to do the same thing, back when I believed I could anticipate the market's intent instead of aligning with it. But the truth is, the market doesn't care about what you think should happen. It will humble you, shake you out, and make you question your plan until you finally surrender to what is. So don't chase. Observe. Your job in that quiet phase isn't to act, it's to listen. The second clue comes from the one thing that never lies: the collective participation of traders, what you see as volume. Remember what we said earlier. Volume represents conviction. When price stays tight, look deeper at the rhythm beneath it. You'll notice lighter activity when price drifts lower and slightly heavier surges when it tests the top of its range. That's not random. That's accumulation. Someone is positioning, calmly and quietly, while the rest of the market sleeps. Have you ever wondered who's on the other side of your trade? It's not luck. It's the consistent trader who acts from confidence, not emotion. They aren't reacting to noise. They're expressing trust in their edge. When you notice volume, rising subtly on strength and fading on weakness, that's your second clue. Controlled confidence is entering the market. The professionals aren't guessing. They're preparing, long before the breakout becomes visible. Now the third clue, and this one took me years to internalize, is what I call the emotional test of structure. Before a breakout truly unfolds, the market likes to test the emotional boundaries of its participants. Price often dips, sometimes sharply, back into a known support level. The amateurs panic. They see danger and exit. But in truth, the market is probing for weak hands, clearing emotional clutter before a clean expansion can occur. That retest, that moment of discomfort, isn't failure. It's confirmation through pain. How many times have you been shaken out just before the move you'd been waiting for finally happened? Every trader has. I certainly have. That's why you must learn to wait for evidence, not emotion. When the market rebounds after that test and holds firm, it's telling you something very clear. Emotional imbalance has been resolved, and the path ahead is open. These 3 clues, tightening range, volume behavior, and the emotional retest. They're not just technical patterns. They're lessons in patience and emotional mastery. You can't rush them. You have to feel the market's rhythm by being present, not predictive. Trading isn't about foretelling the future. It's about staying aligned with what's unfolding right now. When you understand that, the breakout takes care of itself, because your state of mind is already prepared for it. They're not just watching price, they're reading behavior, sensing the rhythm of market psychology, waiting for the precise moment when collective belief quietly tips in their favor. They understand that by the time the public reacts, the effortless part of the move is already gone, and it unfolds the same way every time. First comes the stillness, that stretch of emotional boredom, then the quiet buildup of confidence, and finally the sharp release that seems to shock the crowd, but surprises no one who was mentally prepared. There's a deep psychological truth here. Most traders can't handle boredom. They equate inactivity with failure, believing that being out of the market means they're falling behind. They crave engagement, action, proof that they're doing something. But trading isn't about activity. It's about alignment. The consistent trader learns early that doing nothing's often the most profitable and most uncomfortable skill to master. The boredom phase doesn't just test your strategy. It tests your emotional structure. It whispers, "You're missing out. You should act." But the trader who can silence that inner voice, who can observe the quiet without reacting to it, that's the trader who catches the move before the noise begins. Notice what happens when the breakout finally arrives. Suddenly, everyone wants in. News feeds ignite, social chatter explodes, and every newcomer believes they've spotted the next big thing. That's excitement. And that's when professionals begin to distribute. They're not chasing momentum. They're managing emotion. Their work was done during the silence, when they entered calmly, without crowd approval. Why does this work so well? Because the market is nothing more than a mirror of collective emotion. Most people act from fear or euphoria, not from structure. When the market grows quiet, they lose focus. When it becomes loud, they lose control. Professionals invert that pattern. They use the quiet to prepare and the chaos to exit. They understand that excitement erodes discipline, while boredom breeds clarity. And let me tell you, boredom feels unnatural. It runs against every human impulse that equates movement with progress. But the greatest trades I've ever seen come after long stretches of psychological stillness. Those were the trades that demanded patience, faith, and neutrality. When they finally unfolded, there was no guessing. There was readiness. So how do you rewire yourself to see boredom as opportunity? You begin by reframing your perception of time. Most traders treat time as a cost, as if waiting diminishes their worth. But the professional sees time as a filter that separates the emotional from the disciplined. The longer a setup matures, the fewer impulsive traders remain to distort it. By the time the real move starts, only the patient remain. And that's where edge exists. You also learn to find peace in stillness. Embrace the sideways grind, the narrow ranges, the vanishing volume. Because those are the moments when the market hides its next story. If you look closely, you'll spot subtle footprints, a higher low here, a quiet uptick in volume there, a gradual tightening of range. These are the signs of positioning, invisible to the impatient. They're not glamorous, but they're real. As the saying goes, buy when it's hardest to buy, sell when it's easiest to sell, It's hard to act when nobody else cares, but that's precisely when risk is lowest and reward potential highest. Think of boredom as camouflage for opportunity. The market doesn't reward attention seekers. It rewards self-control. If you can stay centered through monotony, you'll see what others overlook: early structure, emotional balance, and hidden strength. Then, when excitement returns, you won't be reacting. You'll be collecting on the patience you invested earlier. Price must prove intent before you commit. That's one of those psychological truths you only internalize after experience humbles you. Every trader begins by projecting belief onto the market. They see a pattern and convince themselves they know. But the market doesn't validate belief. It validates behavior. It moves not when you want it to, but when collective conviction aligns. When I say price must prove intent, what I mean is simple. Don't invest emotionally before the market expresses clarity. Until it does, every opinion is speculation. A chart can appear perfect one minute and betray you the next. The difference between a professional and an amateur isn't accuracy, it's patience for proof. Professionals let the market declare itself. Amateurs demand that it conform to their expectations. Consider the classic breakout setup. Everyone loves the fantasy of getting in early. It feels smart, anticipatory. But that anticipation usually turns into frustration. The stock nudges above resistance, flashes green, then collapses. A false breakout. That's what happens when you act on the hope of confirmation instead of waiting for evidence of it. Real confirmation doesn't just show a breakout, it sustains it. It's backed by volume, by conviction, by persistence. It's the difference between a flicker and a flame. A flicker teases. A flame transforms. When price holds above resistance and behaves as if the market now agrees with your thesis, that's confirmation. Ask yourself, do you want to be right or do you want to be profitable? Because those are not the same thing. The trader who needs to be right acts first. The trader who seeks profitability waits for proof. Waiting doesn't make you late. It makes you protected. You can always join a move that's proven itself. It's far harder to recover from one that collapses right after you enter. The market is full of psychological traps designed to expose impatience. False breakouts, head fakes, emotional bait. They exist to transfer capital from the impulsive to the disciplined. The consistent trader waits for confirmation and then rides the wave of emotional imbalance created by others. Waiting for proof isn't just a tactic. It's a mindset. It's humility in action. It's understanding that you don't control the market, only your response to it. That awareness safeguards your capital and your sanity. It teaches you to respect uncertainty instead of denying it. Think back to those quiet phases we discussed, the zones of boredom that most avoid. That's where evidence starts to appear. You'll see the market quietly organizing, higher lows, firmer bids, volume tightening. But that's still potential, not proof. Proof arrives when the market acts with conviction, when it breaks and holds, when weakness fails to pull it back, when demand absorbs every dip. That's the market confirming readiness. The same principle applies in reverse. Before shorting, wait for behavior to reflect weakness. Lower highs, failed rallies, heavy volume on declines. Those are the signs of intent. Professionals don't assume direction. They observe and align. Price and volume never lie. Opinion always does. Most traders lose because they crave certainty before it exists. They want emotional comfort, not objective confirmation. But the only certainty in trading is uncertainty itself and your ability to remain balanced within it. Every consistent trade begins not with prediction, but with perception. You observe, You wait. And when the market shows conviction, you act, not from fear, but from trust. Now ask yourself, how many trades have you known would work only to watch them fail? And how many have you hesitated on, thinking you were too late, only to see them soar? The first lacked proof. The second had it. But you didn't believe it because it looked too obvious. Yet the market often rewards the obvious, when it's backed by real conviction. Amateurs think confirmation means they've missed the move. Professionals know confirmation means they've validated it. There's a world of difference between a move that's real and one that's an illusion. A genuine move will always give you another opportunity to align with it. A false one won't. That's why patience, not prediction, is a trader's sharpest edge. It's not about having the right indicator or the cleverest setup. It's about the willingness to wait until the market reveals its intent. Sometimes that clarity appears fast. Other times, it takes days of quiet observation. You might see a breakout followed by a tight consolidation just above resistance. That's conviction, that's structure. It's the market saying, I meant it. But when price breaks and collapses back below that same level, that's hesitation, that's uncertainty. Learning to distinguish between the two, to listen, not impose, that's the difference between emotional trading and professional awareness. When you start trading from this mindset, you stop trying to force understanding onto the market and begin listening to it. Price isn't chaos, it's communication. Every bar, every retracement, every pause, it's information. When the market whispers uncertainty, you wait. When it speaks with conviction, you act. That's what price-proving intent really means. It's the market revealing which group, buyers or sellers, truly has control. And once you master that waiting, trading gets quieter. You're no longer chasing every uptick or flinching at every pullback. You're simply waiting for the market to express itself clearly. And only then do you align your action with its direction. Because real traders don't anticipate noise, they respond to evidence. Here's something every trader should keep close. Volume patterns whisper before breakouts shout. Price shows what's happening. Volume reveals who is making it happen. The truth of every breakout starts long before it's visible on the chart. In those subtle, almost invisible shifts in volume that hint at quiet accumulation. When you learn to recognize those whispers, surprise breakouts stop surprising you. Most traders only see the surface, candles, lines, shapes, but miss the deeper rhythm beneath. Volume is that rhythm. It's the emotional pulse of the crowd. When a breakout occurs, it's never magic. It's the inevitable result of sustained preparation, often visible to the observant days or weeks earlier. The key is knowing what to look for. Many think volume only matters when it spikes, when it screams. But by the time that happens, the professionals have already acted. The real clues come earlier, in the soft, consistent changes. Slightly higher volume on up moves, lighter volume on dips. That's not randomness. That's demand quietly building. That's intent. When buyers begin leaning in while sellers fade, tension accumulates beneath the surface. It doesn't look dramatic, but it's visible to the patient observer. Those asymmetrical volume days, more activity on strength, less on weakness, that's where smart money hides. They're not chasing headlines. They're building quietly, one careful position at a time. They keep the price contained because they're not trying to trigger attention. Not yet. Often, right before a breakout, you'll see a dull, narrow range. The candles look lifeless, the chart uninspiring. The crowd calls it dead money, but beneath the surface, the rhythm shifts. Volume subtly increases when price presses upward and softens when it pulls back. That's not coincidence. That's control. That's accumulation. When I started, I used to ignore volume. I thought it was secondary noise. I obsessed over indicators and patterns that made me feel smart. But experience taught me that price can deceive, while volume almost never lies. A true move breathes through volume. You can feel its pulse building before it explodes. The chart may look flat, but the heartbeat quickens. The market is inhaling before the breakout exhale. Here's the paradox. Sometimes the signal isn't in the increase of volume, but in the absence of it. When the market grows eerily quiet, when activity fades to almost nothing, that silence is meaningful. It often signals exhaustion. When sellers run out of energy, it doesn't take much new demand to lift price. That's why so many breakouts begin softly, with a whisper that builds into momentum. Think of volume as your early warning system. It won't tell you the exact moment, but it tells you when a move is maturing. The pattern always follows the same psychological rhythm. First comes the quiet accumulation, then tightening of range, then the subtle increase in participation, and finally, the explosion the crowd calls unexpected. You don't call it that, you call it confirmation. Remember what we said earlier about price-proving intent? Volume is how the market whispers that intent before the breakout. Before price declares, volume hints. That's why studying it matters more than drawing perfect lines. A resistance level means little on its own, but when pressure builds beneath it, that's a living setup. That's tension waiting for release. Most traders miss these nuances because they can't sit still long enough to see them. They're busy chasing movement, not meaning. But the professionals, the ones who consistently win, read the quiet as clearly as others read the headlines. They don't predict, they prepare. They understand that the goal isn't to guess when a breakout happens, but to recognize where the groundwork is forming. Volume shows you that groundwork. It's like seeing footprints before seeing the runner. Ever wonder how professionals seem to know before everyone else? They don't know the future. They're simply attuned to the present. They listen. Volume speaks softly first, revealing where conviction is gathering. Once you learn that language, you can feel the difference between quiet accumulation and aimless drifting. And when the breakout finally comes, volume no longer whispers, it roars. You'll see that unmistakable expansion, the surge of participation that validates all your preparation. That's not the time to analyze. That's the time to act, because by then you're not reacting. You're aligning with what you've already understood. But discipline still rules the process. A whisper doesn't mean jump in. It means get ready. Prepare your plan, define your levels, wait for confirmation. Because not every quiet buildup leads to a breakout. Some are traps designed to expose impatience. The whisper signals potential. The breakout confirms reality. You need both. Learn to trust what the market communicates through behavior, not what your emotions insist upon. When volume grows quietly and price stays steady, boredom tempts you to look away. But that's the moment to focus, because when the chart finally looks exciting, it's already too late. The pros are exiting while the crowd is just arriving. The market always leaves clues. Volume is the clearest of them. The footprint of intention, the language of participation. You can't hear it if you're chasing, distracted, or emotional. You only perceive it when you're calm enough to listen. Emotional detachment sharpens observation, and that's the foundation of all consistent trading. It sounds simple, but it's one of the hardest lessons you'll ever learn. The market preys on human emotion, excitement, fear, greed, frustration. It feeds on them all. The instant you let emotion mix with decision, clarity fades. You stop seeing and start reacting. The tape keeps speaking, but you can't hear it anymore. Your feelings drown it out. Trading isn't about fighting the market. It's about seeing it clearly. The more emotion you inject, the blurrier your perception becomes. You start seeing what you want to see instead of what is. That's why the best traders don't just study markets, they study themselves. Because your greatest obstacle isn't the chart, it's your own impulses. Emotional detachment isn't coldness, it's clarity. It's the ability to see the market as neutral, as information, not judgment. Ask yourself how many times you've held a losing position because you didn't want to admit being wrong, or jumped too early because you couldn't bear missing out. Every trader has. I have. There were times I convinced myself a bad trade just needed more time. But the market doesn't reward hope. It rewards discipline. Hope is emotional. Observation is rational. The moment you start defending a position instead of studying it, your edge is gone. The detached trader doesn't marry trades, he evaluates them. He observes, tests, and if the behavior doesn't confirm, he exits, no hesitation, no attachment. That's the true divide between emotional and professional trading. The amateur wants the market to make them feel something. The professional wants the market to show them something. Detachment lets you see the difference. When you're emotionally involved, every tick feels personal. A loss feels like failure, a gain like validation. But the market isn't speaking to you, it's speaking to everyone. Price doesn't care about your entry or your expectation. It reflects only the balance between belief and doubt, buyers and sellers. Your job is not to argue with that balance, but to read it clearly.